Let's have a look at identifying a long signal with the commodity market. For this example, I'm going to use the product that is the E-mini S&P 500 Index Futures Contract. Now, because we're trading a futures contract, each contract has specifications set by the contract provider. You will learn all of the contracts and their details through the future training. For this example, the point value of the E-mini S&P 500 is $50, and each point is made up of 4 ticks that are worth $12.50 each. So now let's have a look at a long signal trading the E-mini S&P 500. To do this, let's have a look at a chart. So on the chart you can see here that we have a long signal. Now what is a long signal? A long signal is when we buy into the market and we want to anticipate that the market will rise, and then we want to sell at a later stage, realizing a profit. That's what we want to happen. So we are looking for a long signal here on the chart, and that is represented by when the green line crosses above the red line, and both of those lines are pointing in an upward direction. If the lines have crossed and they are not pointing in the correct direction, this is not a signal. Now when this cross occurs, we want to enter the market long at the closing price of the cross. So in this case, for this example, the closing price of this cross is 1,100. Now what do we always do when we enter the market? We always have a stop-loss order in place to protect ourselves. And this is a positive thing because we want to manage our risk like a professional. So to enter this trade, we also need to consider what the long stop price is. And for this example, the long stop price is 1,080. What does that equate to? So we have an entry price of 1,100, we have a stop price of 1,080. That gives us a total of 20 points at risk. Now let's see if you can calculate this. What was the point value for the E-mini S&P 500? It was $50. So if we have 20 points at risk at $50 a point, how much are we risking on this trade? $1,000. Now that we've entered this trade and we have protection in place, we need to check the trade and at each update time to see how the trade progresses. So as you can see here on the chart, we've followed through on this trade, and we need to check the closing price of the next update, which happens to be 1,105. What does this mean? This means at the moment we have a 5-point gain. However, what do the lines indicate? Is there a cross or isn't there a cross? If there is not a cross, we need to stay in the market, because we are only going to exit when the market indicates for us to do that. So there is no cross, we are going to stay in for this update. The next step is to check the next update to see what we need to do from there. When we check at this update, you can see that the closing price is at 1,090. Previously, the price was at 1,105. So what is happening now? We have seen that the market has declined a little bit, and we are now holding the position that isn't winning. But that's okay. We need to check if the lines have crossed or if they haven't crossed. If they haven't crossed, what do? We stay in the trade. So, given what our chart is showing, the lines have not crossed, so we would stay in this trade at the moment, knowing that we are fully protected because we have our stop in place. Knowing that we're never going to be right 100% of the time, stops are actually one of the biggest allies we have, because when we get stopped out, we know that we've only lost a small amount. And when we get stopped out on the trades losing a small amount, that gives us the opportunity to be in the trades and let them run for our winning trades to be the most profitable they can be. This enables us to maximize our success over the long term with our trading. Of course, with trading, we're never going to be right 100% of the time. And it's important just to realize that when we have a down trade or get stopped out on a trade, this is our money management practices working.